Good morning. It's Wednesday, the 3rd of April, and this is Govindraj Ethiraj broadcasting from Mumbai, a distinctly warmer India's financial capital. Our top stories and themes for the day: a manufacturing index for India touches its highest level in 16 years. Portfolio investors are now switching out of India into China. Heat waves could hurt the economy in more ways than one, including inflation. Investment intentions are high. How much is getting converted and how airlines are leading a lot of it? And why Indian airlines struggle when faced with crisis.
This is a core report with Govindraj Ethiraj.
Investors resume search for a rally that may not materialize. Investors are grappling with a mild conundrum. Where is the pre-election rally? Now, data suggests that you could have one if expectations of the return of the party in power were low, let's say 6 months before elections, and then as expectations changed or improved closer to elections, obviously the rally would begin. Reuters points out that historically, Indian equities have started strong in election years, with the Nifty index averaging a 5.2% return in the first quarter of the previous 3 election cycles. However, the index has only seen a 2.7% increase in the same period this year. Now, elections are due to start in a few weeks on April 19th, and obviously expectations are roughly the same that they were about 6 months ago. And thus, the markets have little to celebrate, since the celebrations for all practical purposes have begun much earlier, or in market terms, a victory is already priced in. On Tuesday, the Sensex drifted into the green in the early hours of trade, but then drifted out again, ending at about 73,904 points. That's down 111 points. The Nifty50, on the other hand, ended at 22,453, down just 9 points. So not much change there. The MidCap and SmallCap indices did better on the BSE, up 1% each. And this is a segment that has been doing well in the last few days. And as we've discussed yesterday, the MidCap and SmallCaps have shrugged off regulatory scrutiny, overhang, or the many warnings of froth and exuberance from the Securities and Exchange Board of India. Investors are eyeing China once again. Now, we've been discussing the China stocks rebound for some time now, but it appears that the rebound could start pulling away some funds from India, albeit small amounts. Bloomberg is reporting that funds like Lazard Asset Management, Manulife Investment, and Candriam Belgium are paring exposure to India after a record-breaking rally and switching to China as Beijing's support for its economy spurs a recovery in industrial profits and manufacturing. Now, this swing is also suggestive how China has managed to sway opinion in its favor on its own economic focus and, of course, the potential to offer returns to investors. In this case, we're talking about overseas ones. Now, this is not to say that major Wall Street banks have changed their view on India as a key investment destination for the next decade, as we've heard and documented right here in recent months. But it's about value or perceived value again right now. James Donald, head of emerging markets at Lazard Asset, told Bloomberg that as China has got cheaper and cheaper, some of their Chinese investments have become less valuable, but the investment case for them has increased. HSBC Holdings has said that more than 90% emerging market funds are adding back their positions in mainland Chinese shares, which were underweight, while also dialing back exposure to India, according to Bloomberg. A portfolio manager told Bloomberg that Candriam's $2.5 billion emerging markets fund has raised its exposure to China, partly at the expense of India. According to them, they've positioned India as a funding source for some interesting themes that they find in China, particularly those related to self-sufficiency and localization, and were adding names in the semiconductor supply chain because China would increase spending there. Now, this is, of course, interesting since India too is seeing semiconductor projects coming up, but funded by companies along with government aid or subsidies, like, I might add, in other parts of the world. The MSCI China Index, incidentally, is trading at 9.1 times its one-year forward earnings, 60% cheaper than the multiple for the MSCI India Index, which hit a record last month. So the answer to the question that you might have could lie in that, which is quite simply valuations. So the conclusion for now is that fund managers continue to see the decadal growth story of India as positive and are betting on political continuity, but are equally concerned about valuations, something that they've been expressing quite openly and even vociferously over the last few months. And this, interestingly, is being expressed by fund managers both global and domestic. Of course, this entire argument was about overseas funds. India has had strong domestic flows as well, and that's what has kept the markets booming for most parts of 2023 when foreign investors were selling. Oil is approaching $89 a barrel. Oil prices are breaking out of their lower trading band and moving higher for the first time since October, as visible via Brent crude prices, which are over $88 a barrel and just below $89. While production curbs from the Organization of Petroleum Exporting Countries like Saudi Arabia and its allies have been in place for several months now, prices are now inching up because of demand projections which are seen as higher, which was not the case even a few months ago. So crude is up roughly 11% this year. Tensions in the Middle East, which have caused ships to divert away from the Suez Canal to around Africa, have also added to the premium risk, which also includes problems with Russian supply, hampered in parts by attacks on its oil installations by Ukraine, all of which was pointed out last week to us by Vandana Hari, oil analyst based out of Singapore. India, among other countries, has been seen as driving up global demand and thus prices. If you want good news, this is it. A little over a year ago, traders were predicting and projecting that oil could return to $100 a barrel. It did not happen. India, among others, was seen as driving global demand and thus prices up. So, demand is still strong, as various agencies have pointed out, but not yet sufficiently to take prices to those frightening triple-digit levels, at least for now. Could heat waves push up prices of agri-products? We reported yesterday that heat waves were expected for 10 to 20 days in different areas during the 3-month period ended June 30th against a normal of 4 to 8 days, quoting a top official of the Indian Meteorological Department. Above normal maximum temperatures are likely over most parts of the country, that official had said. Now, heat waves will have several points of impact, including workers toiling in the open and then agricultural products and vegetables. The bigger and more immediate concern is inflation. I reached out to Teresa John, an economist with Nirmal Bang Institutional Equities, who's been working on the correlation between heat waves and inflation. I began by asking her how she was seeing the impact of heat waves on the economy right now.
So if you see the contribution to inflation over the last couple of months, inflation has mainly been led by food prices and more so by vegetable prices. Actually, if you see the disinflation in vegetable prices on a month-on-month basis, what we estimate is that in March itself, it has slowed. And if you do have a heat wave, you could potentially see higher vegetable prices in the months ahead, which could keep inflation elevated. We don't see any significant impact on the Rabi crop as of now because probably you are already at the end of the Rabi crop and the harvest is starting. So we do not see too much impact in the Rabi.
Right. And when you say vegetables, so could you relate it to two things? One is what would it be or potentially be in terms of numbers, and how does that relate to previous years?
So too early to say in terms of numbers because the heat wave is actually not hit and we don't know where. I mean, there are some predictions which is going to be in Maharashtra, Gujarat, North Karnataka, but we've not really seen that pan out. So difficult to say in terms of numbers. See, vegetable inflation remains at very high double digits on a year-on-year basis, even now. And on a month-on-month basis, we're not seeing inflation fall. So at least my own estimate is that on a month-on-month basis, vegetable prices will be broadly flat between February and March. So if we sustain at this level and probably a heat wave could lead to a further spike in prices, if it pans out, then you'll have a situation where your vegetable price inflation will continue to remain in double digits and probably that will impact your headline inflation as well.
And we saw some illustration of this last year, right?
Yeah, last year the heat wave was actually in March, so it had an impact with the Rabi wheat harvest. So it was flat on a year-on-year basis. This year it's coming a little later, so probably that's why I said maybe not too much impact on the wheat crop, and that's what even the IMD has said. That probably the wheat crop may not be impacted, but it will be the crop between the Rabi and the Kharif that may be impacted.
So, slightly broader question, Teresa. So, as an economist, I mean, do you factor in or are you likely to factor in climate change as a input or a increasing sort of input point in your forecasts and studies?
So on inflation, we have to factor it into account. I mean, because it's ongoing, and this is what we're seeing every season. In terms of the impact on growth, I don't think, at least in India, we are factoring it in a significant way as yet. But potentially going forward, if there are very significant changes in agricultural cropping patterns, then we may have to take that into account. But that said, I'd also like to leave you with the point that So when we speak to a lot of people in government, in agricultural scientists, etc., they are all talking about introducing various like genetically modified and climate resistant crops. So probably while there will be some impact from hotter weather or harsher winters, you are increasingly having more climate resistant varieties, whether it is for rice, wheat, pulses being introduced. So to that extent, the impact on actual agricultural output may not be as much as we would otherwise have thought it to be.
Right, Teresa. Thank you so much for joining me.
Yeah, thank you.
India's manufacturing sector expands at a 16-year high as jobs also grow. Perhaps after GDP numbers spiked last quarter to 8.4%, rather unexpectedly for even the most bullish of Indian economists, the next number to provide some joy is clearly this new manufacturing index number. India's manufacturing sector in March reached its highest level in 16 years, with production and sales expanding at their fastest rate since October 2020. HSBC India Manufacturing PMI was at 59.1 in March, with India seeing a near record increase in input stocks. PMI, short for Purchasing Managers Index, in February was 56.9, the fastest pace in 5 months. The report said that growth could be attributed to a boost in new orders, output, and input stocks accompanied by renewed job creation. The outlook looking ahead for the Indian manufacturing sector appears to be mixed. Companies remain generally optimistic, with 28% forecasting output growth in the year ahead, though concerns over inflation persist. And more on that, which is the output growth and expansion ahead shortly. How India Inc.'s investment intentions measure up and where. Now, there has been an improvement in investment announcements in 23-24, the year that just ended, which though lower than the previous year is higher than all other periods in the last 10 years. So in the last 10 years, we have seen the second highest quantum of investment intentions announced by India Inc. Now, these are only intentions which would fructify over a period of time and reflects the mood of companies, a note from Bank of Baroda Research quoting CMI data points out. Among the investment intentions, there is a concentration in segments related to government spending besides electricity and transport services. So the current figure overall is about 27 lakh crore rupees. Incidentally, these numbers include private and public sector intentions, but also within that include airlines. Remember all those mega orders on Airbus and Boeing? All of this makes up for a large part of overall intentions for the last year. So, chemicals, electricity, and transport, that's mostly airlines, was 72%. So, if you're trying to form an opinion on the mega growth sectors in India right now, or at least going by investment intentions, these are it. Now, the question, of course, is what is the rough conversion from intention to on-ground investments? How does one measure it? And how do other data points triangulate, if so? I reached out to Madan Sabnavis, Chief Economist at BOB Research, and I began by asking him what do these numbers translate to, and also about capacity utilization levels in Indian industry right now, which are of course a good indicator of overall activity following from our earlier manufacturing PMI numbers, as well as a pointer to fresh investments ahead.
See, the major point which comes out from this particular number is that the confidence level in industry has actually improved and it's gotten back on its feet. Because there was this particular phase during COVID or just about post-COVID where we had seen that there was a bit of pessimism. Then we saw that things, because of the pent-up demand which we saw also in terms of overall consumption, investment, things did pick up for a couple of years. But of course, what we saw in 22-23 when these announcements had peaked was also the time when the base effect actually kicked in. Okay, because what you didn't do for a couple of years might have been loaded into 22-23. So we had a peak number coming there. And what we see in 23-24, while the number is lower than that in 22-23, so then we get this image saying that, okay, this is a more realistic number. And we definitely do get the signals that Indian industry is definitely keen in terms of investment. And that is what is coming from these numbers. Of course, we should remember that these are only intentions. When I make an announcement, the actual fructification of it will depend upon a number of factors. We're not really quite sure about how this will be spread out, whether it be 3 years, 5 years, or 10 years, when exactly these things do materialize. But I think it is more a kind of a confidence kind of a number which we get, which I think is positive for us.
And if you were to look at the translation or conversion to execution, I mean, maybe not from these specific intentions, but you were to independently look at, let's say, the balance sheets, as I think you have, and what kind of assets they've been creating, and look backwards, what would you say the conversion level or rate is?
See, what we have seen is that if I look at balance sheets of companies and then look at what kind of growth has been in their capital formation, that is based on just the gross fixed assets numbers which are revealed in their balance sheets, we see that in the last couple of years, that is, I'm talking of 22, 23, because 23, 24 numbers are not yet out, but up to 22, 23, we have seen that there's been a growth of around 10 to 12%. But I think what is important here is that this 10 to 12% masks the fact that this is not really broad based. We are seeing it in certain specific sectors. And the image we get is that wherever we have a front end coming in terms of the government spending, that is in the infrastructure sector, those are the sectors where we see more assets being created. So, for example, if I look at steel, I look at machinery, I look at cement, there's definitely been a case of buildup of assets. Independently, of course, the power sector, something which we are seeing even in terms of the announcements, where the electricity sector has substantial share, I would tend to believe that is more on account of the thrust being given to renewables, that we are seeing that there is a bit of asset creation happening even in the electricity space. We're also seeing it happening in the oil space. So I think those will be the two sectors besides the core infrastructure, which is related to government spending, where there has been good amount of investment taking place in real terms.
Right. And just to reiterate the context, this is private capex that we are talking about, right?
It includes also public sector, but not government spending. So if I have an ONGC spending, it'll get included, but not central government or state.
So it would include, let's say, listed companies or the entire listed universe and private companies as well. Okay. So we saw the investment intention at 38.9, which is almost 39 lakh crores in 22-23. That's the year before, financial year. And we saw 27 lakh crores in 23-24. Now, the highest actually in the last 10 years was 22-23. So any specific reason that you're seeing for that?
No, I think this is primarily on account of the fact in the prior 2 years, we had seen a fall in terms of the intentions that was on account of COVID. So I think the pickup which we saw was that it's a case of companies recouping what they couldn't do in the previous 2 years for something which came into 22-23. And that's why we see a bump up to this level of 39 lakh crores. So the reason why I say that the number for 23-24 at 27 lakh crores is very impressive and gives you that kind of confidence is that notwithstanding the fact that we have had this number of 39 lakh crores, we're still saying that the industry is keen on investing. And that's because they see this potential growth which is seen in the economy. And the fact that India has been the fastest growing economy, the 7.5% numbers which we're talking of, is something which we expect will be repeated in the next couple of years too. So I think that's the way I would be looking at it.
Are there any other triangulatory data which converge on overall investment execution or any other data point that says or suggests how companies are looking at the year ahead?
See, I think one thing which you can look at is on the financing side. So I think there was some data which has been released by Prime Database, which shows that if you look at the total corporate bond issuances in 23-24, it was again something in the region of 9 lakh crores plus, which must be the highest amount which has been raised. So I think that is one particular element which one can look at. We have seen the external commercial borrowings have also done very well, notwithstanding the fact that interest rates have been higher in the global markets. We have seen bank credit. Of course, a large part of bank credit, 60% would be for term loans. So that again has been growing at around 16% on a year-on-year basis. We're getting this picture that there is a lot of interest which is there for long-term investment. And that sort of corroborates the fact that these announcements which have been made are more likely to fructify at a faster rate in the coming year as the Indian economy continues to grow at this 7.5% average growth.
More sort of a layman's question. So, the growth rate of, let's say, 7.8%, which you're saying will be maintained for next year, is a result of these investment intentions, or is it the other way around?
No, actually, it works both ways because overall GDP growth is between consumption and investment. They are the two major factors besides external sector and government spending. So if investment goes up, my GDP goes up. But as your GDP keeps going up, there is a case of producers investing more, because if you expect growth to be retained at a rate of, say, 7.5 or 8% for the next 5 years, which is what we believe will happen, then it's but natural that as an entrepreneur, you will be planning your overall investment to make sure that you keep pace with the kind of growth you're seeing in GDP. So I think it's a two-way kind of a relation which takes place, because as growth increases, you create more jobs, there's more consumption. As there's more consumption, there's better capacity utilization. As there's better capacity utilization, there is more demand for investment. That's when you go in for higher investment. So I think all these pictures do fit in fairly comfortably as of now.
We've seen very high manufacturing PMI numbers just been released. So, highest in 16 years, according to the agency that has released them. My larger question is, where are we on capacity utilization at this point?
So I think we've seen capacity utilization is differential depending upon the kind of industries which you're looking at. Unfortunately, the data which the RBI brings out is for an overall sample. It doesn't really give it a disaggregated basis. But when we looked at numbers, say for September, I think that's when the balance sheets of companies actually the companies provide the balance sheets as of September. That is the first half of 23-24. And we look at the asset turnover ratio. So essentially, that's a kind of a very broad proxy for capacity utilization. With the same set of assets, are you able to generate a higher sales? If I get a higher level of turnover, it means there is better capacity utilization taking place. What we have seen is that it's more selective in industries. Going back to what I said earlier, infrastructure-based industries have seen better capacity utilization based on the asset turnover ratio analysis which we have done. However, if I look at the consumer-based industries, we do not see a similar kind of picture. So I would tend to believe that while capacity utilization ratios are improving, and I'm sure that by we come to March, the number should be in the region of 74-75% for the aggregate. That is what the RBI numbers will come out maybe after a couple of months or so. I think numbers would tend to be higher in industries like steel. For example, if you look at some of the commentaries made by the steel companies during their investor presentations, they are operating at over 100%. You talk to cement, they're also operating at around 90%. And typically it is felt that if my capacity utilization ratio crosses 78 to 80%, that's when you go in for fresh investment. So I think for metals, for cement, for chemicals, I think these are the three segments where definitely the capacity utilization rates would be high. But if I look at the consumer-based industries, that is including food products, durables, your FMCG goods, I think there's still quite a bit of distance to be covered. So there I would tend to believe that the capacity utilization ratios should be closer towards the 70% mark, and they still have excess capacity before they go in for fresh investment.
Madan, thank you so much for joining me.
Thanks a lot, Govind.
Why do Indian airlines get blindsided by crises? In September 2023, 40 pilots of the newly launched Akasa Air's 450 pilots roughly quit without any notice. They quit because they were likely poached by rival airlines. Now, I don't know if Vistara was the airline or one of the rival airlines, but that's not the point here. Akasa at that point had to cancel some 600 flights in August. It had told a court when filing cases against these pilots for breaking their contracts. Now, Vistara pilots have been for the last 2 days staging walkouts, Lufthansa style, apparently over the lower compensation they would get when Vistara would get merged into Air India. Both are now owned by the Tata Group. Now, thanks to these walkouts, scores of flights have been cancelled in the last 2 days on Vistara, putting considerable strain on passengers who are, of course, finding out about those cancellations after travelling maybe 2 hours or more just to reach the airport, like in Bangalore. On social media, one passenger said the pilot walked out after they boarded the flight. At this point, it does appear that a merger between Vistara and Air India, while fully logical, would likely be a disaster for Vistara for some time at least, because it operates on a much higher level of efficiency and product quality and freshness and comes with a baggage-free existence. And I don't mean the baggage you check in while traveling. So the pilot walkout is the first sign of trouble. But let's see the broader context. First, India's aviation sector is exploding, including via the airline orders that we just referred to, amongst the highest in the world at this point. India's domestic air passenger traffic grew about 8% year-on-year to 152 million in calendar year 2023. So as traffic grows, whether it's domestic or international, there will be trouble at various points, including during winter, which saw cascading delays, as we saw just a few months ago. Or go back a year ago to December 22, when massive lines at security check and immigration at Delhi airport led in turn to freight tempers and missed flights, and then triggered a visit by the aviation minister to the airport to take stock. As it happened, everything died down soon, maybe because winter ended or the aviation minister's visit actually made a difference. Bottom line, for one reason or the other, airlines will face problems. So there are two problems with the Vistara situation, which I think is an insight and a lesson. First, it's an intelligence failure. Pilots don't just wake up one morning and decide to walk out. If it's a move that could surely jeopardize their jobs, even for a short time, they would have had to do some consultation and thinking through. Now, the airline was obviously aware that pilots were unhappy, but not aware about how much, and surely not the action that could follow. Second is that regardless of what that specific action is, bad weather, long lines, or pilots getting boshed mid flight, in a manner of speaking, airlines have to have better response mechanisms and communication, which is that passengers have to be told via this thing called the mobile phone that there is a delay or cancellation. The wording of these things is, of course, tricky because airlines precisely don't want to announce cancellations when they're trying to fix the problem just in time. But this goes back to intelligence and, of course, a better standard operating procedure or procedures when things go wrong. The experiences of the last year and a half tell us that airlines have been very poor in managing their own responses and communications, which has typically made the crisis worse. Now, there will be many more such challenges going ahead, and once again, in the context of a rapidly growing industry, airlines should be clearly better prepared and geared to communicate better with their customers and passengers, who, of course, are responsible for their existence. There is nothing like too much communication. Meanwhile, the Bureau of Civil Aviation Security, which oversees aviation safety in the country, has allowed passengers to disembark the aircraft and move to the departure terminal if their flight gets delayed due to bad weather, medical emergencies on board, or technical issues. Earlier, passengers would just be confined inside the plane for potentially long periods. And when I say long periods, it could be many, many hours. Of course, you might ask why it took so many years for us to realize something that many global airports don't have a problem with. For example, most US airports have common arrival and departure gates, at least for domestic travel. Not in India, where we build twice or three times the infrastructure for the same outcome. But as they always say, better late than never. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.